2.1 trillion. Say that number out loud, it grabs you, it forces you to listen. Reports have been circulating that BlackRock, the world's largest asset manager, quietly moved $2.1 trillion out of American assets and into markets abroad. If that sounds like a headline you'd expect only on social feeds, that's because it is. But the number is big enough that it matters. Big enough to matter to your pension. Big enough to matter to the interest you pay on a mortgage. Big enough to matter to whether a country's currency stays the global anchor it has been for decades. Let me be clear from the start. When a claim like this appears, two things are true at once. First, it deserves scrutiny. Second, whether the claim is literally true or not, the pattern behind the claim is historically meaningful. BlackRock manages trillions of dollars. Its moves ripple. BlackRock itself oversees more than $11 trillion in assets. The behavior of that capital is a signal, not just noise. By the end of this video, you will understand a repeatable four-step financial pattern that has played out across centuries. You will see the mechanics. You will be able to judge how much weight to place on headlines like 2.1 trillion moved. And you will see what kinds of actions, some institutional, some personal, tend to follow when the pattern runs its course. So let's begin with the model. Keep it simple. Treat it like an equation. The model is a four-step cycle. Step 1. A global power becomes the financial center. This is not just military strength. It is where credit is issued. It is where merchants and governments borrow. It is where contracts are settled in the dominant currency. Step 2. Debt and money creation expand. Wars are financed. Empires promise future taxes. Banks and governments expand credit. The dominant center begins to borrow more and increase the money supply to cover its obligations. Step 3. Smart money exits quietly. Smart money means institutional capital, sovereign treasuries, and large private pools. They do not panic. They reallocate. Quietly. Systematically. Often outside public view. This is capital flight in slow motion. Step 4. The currency loses dominance and decline follows. Sometimes it happens slowly. Sometimes faster. When demand for the currency weakens, because foreign holders reduce exposure or confidence erodes, its privileged position fades. Markets shift. Trade adjusts. Living standards change. This is not a conspiracy. It is a structural pattern. Think of it as a machine with 4 gears. The same gears have turned in different centuries with similar outcomes. We will apply this model in strict sequence to 4 cases. Spain in the 1500s. The Dutch Republic in the 1600s. Britain from the 1700s through the early 1900s. And finally, the modern United States. We keep the sequence. We keep the mechanics. No new countries. No reinterpretations. Just patterns. Now let's test the model, starting where many historians do. Spain. In the 1500s, Spain becomes the financial center of Europe. After the discovery of the Americas, massive quantities of silver and gold flow into Spain. This influx makes Spain the center of a new European money system. Merchants, kings and bankers treat Spain as the place where bullion and credit converge. The treasure fleets represent one of the largest monetary injections in human history. Next comes debt expansion. Spain uses this wealth to fund an imperial project, wars in Italy, wars in the Low Countries, conflicts with the Ottoman Empire. A vast state apparatus, dynastic obligations across Europe. To cover deficits, the crown borrows heavily against future silver shipments. Historical records show that under Philip II, Spanish debt reached enormous levels relative to the size of the economy. The crown defaulted on its obligations multiple times during the second half of the 16th century. Borrowing continued even as earlier promises went unpaid. Then capital begins to move. Smart money does not stay parked in Madrid. Genoese bankers, Antwerp merchants, and other European financiers reallocate risk. Much of Spain's borrowing is intermediated by foreign bankers who recycle capital into other regions. Financial activity shifts toward commercial centers with stronger trade networks and more reliable credit systems. Spain has liquidity, but it does not have sustainable financial control. Creditors reassess risk. When returns fall or risk rises, they move. Then come the consequences. Europe experiences the price revolution. Prices, rise steadily for decades as New World silver floods the system. Fixed incomes lose value. Spain's fiscal structure weakens. Repeated defaults erode its ability to fund wars and maintain dominance. Political power remains for a time, but financial leadership fades. Over decades, influence shifts to new centers. This completes the cycle. Spain rises on a monetary advantage. It borrows heavily. Capital reallocates when risks increase. Inflation and fiscal stress follow. The result is not instant collapse. It is a slow reordering of where capital, credit, and trust reside. Historical records note Spanish sovereign defaults in 1557, 1560, 1575, and 1596, among others. These moments are not trivia. They mark points where creditors reassessed trust and adjusted capital accordingly. Pause here. Spain did not fail because it lacked resources. It failed because its system depended on continuous borrowing and external confidence. When confidence weakened, capital moved first. The consequences appeared later. This is the insight most people miss. Capital always moves before decline becomes visible. Now hold that pattern in your mind. Because next, we move to the Dutch Republic in the 1600s. A smaller power that rose precisely as capital flowed out of Spain. Now we move to the Dutch Republic. The pattern does not reset. It continues. In the early 1600s, the Netherlands is not a vast empire. It is small, geographically constrained, and constantly under pressure. But it has something Spain is losing: financial credibility. As Spanish defaults accumulate and inflation erodes returns, capital looks for a new home. It does not look for the biggest army. It looks for the safest contracts. Amsterdam becomes that place. The Dutch Republic builds institutions that prioritize trade finance, contract enforcement, and transparency. The Amsterdam Exchange Bank is founded in 1609. It provides a stable unit of account backed by disciplined reserves. Merchants trusted. Governments trusted. Capital concentrates there. This is stage one again. The Dutch guilder becomes the preferred currency for trade settlement across Europe. Dutch shipping dominates global commerce. Insurance, futures contracts, and sophisticated credit markets develop rapidly. For the first time, finance itself becomes an industry. Then stage two follows. Success brings leverage. The Dutch state begins to borrow. Wars with England and France are financed through debt. Public obligations grow. The system still functions, but it now depends on continued trade dominance and confidence in Dutch institutions. Over time, returns compress. Competition increases. Britain adopts Dutch financial innovations and scales them. The cost of defending trade routes rises. Debt accumulates. Then stage 3 begins. Capital does not flee Amsterdam overnight, it reallocates. Large pools of wealth begin shifting toward London, where Britain offers deeper markets, a growing industrial base, and a state willing to protect creditors aggressively. Dutch investors themselves finance British ventures. Dutch capital helps build British power. This is critical. The decline of a financial center often funds the rise of the next one. The Dutch Republic does not collapse dramatically. It simply loses its position at the top. By the early 1700s, Amsterdam is no longer the undisputed center of global finance. London had taken that role. Then comes Britain. Again, the pattern continues. Britain in the 1700s and 1800s becomes the financial center of the world. The pound sterling anchors global trade. The Bank of England, founded in 1694, institutionalizes government borrowing and bond markets. British debt is seen as safe. British law protects creditors. British ships control trade routes. Stage 1 is complete. Then stage 2. Britain finances wars on an unprecedented scale. The Napoleonic Wars alone pushed debt to levels exceeding 200% of GDP. Later, the empire expands across continents. Railways, colonies, military commitments, and administration are funded through borrowing. Britain can do this because the world trusts the pound. But over time, pressures mount. Industrial competitors emerge. The cost of empire rises. 2 world wars accelerate debt expansion dramatically. Britain suspends the gold standard during World War I. Sterling weakens. Reserves drain. Then stage 3. Capital begins to move. After World War I, and decisively after World War II, capital reallocates toward the United States. The UF emerges with intact infrastructure, massive industrial capacity, and creditor status. British assets are sold. Overseas investments are liquidated to pay debts. The pound loses its dominant role. The Bretton Woods system formalizes the transition. The dollar becomes the new anchor. Sterling becomes a secondary currency. Britain does not disappear. London remains important, but the center has shifted. Now pause again. Spain, the Dutch Republic, Britain. Different centuries, different political systems, same four stages, rise as the financial center, debt and money expansion, quiet capital reallocation, loss of currency dominance. Now we transition to the present, not emotionally, structurally. The United States enters the 20th century already strong. After World War II, it becomes the unquestioned financial center of the world. The dollar is backed by gold. US debt is manageable. American industry dominates global production. Stage 1, then gradually Stage 2, debt grows. First slowly, then faster. The gold standard is abandoned in 1971. The dollar becomes purely fiat. Deficits become normal, then structural, then enormous. US federal debt moves from trillions to tens of trillions. Money creation accelerates, especially after financial crisis. The system continues to function because the dollar is still the global reserve currency. But that privilege has conditions. Foreign governments must be willing to hold us debt. Institutions must trust US fiscal discipline. Capital must believe long-term returns justify the risk. Now watch Stage 3 carefully. This is where we are now. Capital is not panicking. It is repositioning. Central banks reduce the share of dollars in reserves. Sovereign wealth funds diversify into commodities, infrastructure, and non-dollar assets. Large asset managers increase exposure to international markets, private credit, and real assets. This is not a headline event. It is a flow. Treasury auctions still clear, but at higher yields. Foreign holdings plateau, then decline. Long-duration bonds become less attractive. Institutions shorten duration, hedge currency risk, or move capital abroad. This is what capital flight looks like in a modern system, not suitcases of cash. Balance sheet adjustments. And this is why headlines about trillions moving matter, even if the exact number is debated. The behavior fits the historical pattern. Now understand this clearly. Stage 3 is always quiet. Stage 4 is always obvious. But only in hindsight. We are not at the end of the cycle. But we are no longer at the beginning. What typically follows next in history is not sudden collapse. It is adjustment, slower growth, higher financing costs, reduced monetary privilege, a gradual shift in where global capital feels safest. Now we slow down. Because history shows that what follows Stage 3 is not a single event. It is a process. Capital has already begun to reposition. The incentives have already shifted. What comes next is how those shifts work their way through the real economy. Historically, Stage 4 does not announce itself with a siren. It arrives through friction. Borrowing becomes more expensive. Currencies fluctuate more. Policy choices carry heavier consequences. In Spain, it meant decades of inflation and fiscal strain. In the Dutch Republic, it meant a gradual loss of dominance as trade leadership moved elsewhere. In Britain, it meant accepting a reduced monetary role after the world wars. None of these societies collapsed overnight. They adjusted, sometimes poorly, sometimes well, to a new financial reality. This is the key point. Stage 4 is not chaos by default. It is constraint. When a currency loses some of its dominance, the issuing country must live more within its means. Deficits matter more. External financing cannot be taken for granted. Policy mistakes carry faster feedback. For the modern United States, history suggests several likely characteristics, not predictions, but tendencies. Higher long-term interest rates relative to the past. More competition between currencies and settlement systems. Greater sensitivity to foreign capital flows. And a reduced ability to export inflation without consequences. None of this requires collapse. It requires adjustment. Now, what does this mean for individuals? Not speculation, not panic, positioning. Historically, those who navigate these transitions best share three traits. First, they pay attention to capital, not headlines. They watch what institutions do, not what they say. They notice duration changes, reserve shifts, and allocation trends. Second, they reduce single-point dependence. They avoid being exposed to one currency, one market, or one assumption about permanence. This does not mean abandoning a system. It means understanding its limits. Third, they stay informed and flexible. They understand that long-term financial structures evolve slowly, then suddenly. Awareness provides time. Time provides options. This is not about betting against a country. It is about recognizing that no monetary system has ever been permanent. Dollar's role was earned, and it will change the same way all dominant currencies have changed, through incentives, not collapse narratives. So return to where we started, 2.1 trillion. Whether that exact number reflects a single action or a collection of reallocations matters less than the signal it represents. Large pools of capital are behaving differently than they did a decade ago. History tells us that this behavior comes before visible change, not after it. The question is not whether systems evolve. They always do. The question is whether you notice the pattern early enough to respond calmly and intelligently. So I'll leave you with this. If capital is quietly repositioning, and history shows what usually follows, what does being prepared look like for you? If this helped you think more clearly about money, history, and incentives, share your thoughts in the comments. A thoughtful discussion helps everyone. And if you value calm, data-driven analysis like this, consider liking the video and subscribing. Not for predictions. For perspective, before we close completely, there is one final layer worth understanding. Not a new theory, not a new stage, just a clarification that history makes very clear. When stage 4 unfolds, the biggest mistake societies make is misdiagnosis. They argue about personalities instead of incentives. They debate politics instead of balance sheets. They look for villains instead of mechanics. In Spain, blame moved between kings and ministers. In Britain, debates raged over gold, labor, and empire. In every case, the argument distracted from the underlying shift. Capital was no longer willing to subsidize the old structure at the same price. That matters today. When financing costs rise, governments face harder choices. Raise taxes, cut spending, inflate obligations away, or borrow at higher rates. None of those options are painless. All of them are constrained by how much confidence capital still has. This is why institutional behavior matters more than official statements. Confidence is not declared. It is priced. And pricing happens quietly every day in auctions, allocations, and risk models. For individuals, the lesson remains the same across centuries. Do not confuse stability with permanence. Do not confuse noise with signal. And do not confuse awareness with pessimism. Understanding structural change does not require fear. It requires literacy. History does not punish attention. It punishes denial. And with that understanding, you now have the full pattern. From rise to expansion to quiet exit to adjustment. Nothing mystical. Nothing new. Just repeated human behavior operating through financial systems. The rest is how each generation responds. That truly is the end of the story, at least for now.